Well, good afternoon, everyone. Welcome to Brodie's hosted webinar on deal norms and trends in the M&E market. Thank you for joining us. I'm Eric Galbraith, a partner in Brodie's corporate department with the better part of 40 years experience in the M&E market. We're joined on the panel today, firstly by Ian McCready, who is chair of Quorum Cyber. Sorry, Ian, messing around too much with my computer here. Ian's over 30 years experience within the worldwide telecommunications and IT industries. He was CEO of Cortexica Vision Systems until it was acquired by Zebra Technologies. He was CEO of NeoMedia Inc., a public US-based software business, world leader in barcode creation, capture, delivery, and reading technology. And he was CEO of Edinburgh-based Mobica, leading the company from a startup to the world leader in mobile ticketing, mobile boarding, pass, and couponing solutions. Mobica was acquired by NCR. Prior to that, he was Chief Operating Officer of KSCL, then Scotland's largest software house and a leading supplier of customer care and billing applications to mobile phone operators. He was part of the management team that undertook an MBO before selling to a German quoted business 2 years later. So you'll gather from that we have Ian on the panel because of his extensive M&A experience. We're also joined by Tom Baker, Vice President in the Lockton Transactional Risk team. Lockton Transactional Risks procures warranty and indemnity, tax and contingency insurance coverage. In a year of unparalleled challenge and change for the M&A market, the dedicated team provided critical support for its clients and the wider industry. The team remains the only W&I broker with on-the-ground capabilities outside of London, with specialists in Manchester and recently a new team in Edinburgh. The team's focus is to service deals with hands-on advice, responsiveness, and wider insurance advice around areas including environmental, IP, product recall, and employee benefits. And I should add, besides being VP, Tom is also a solicitor, bringing some technical expertise to this part of the conversation. And thirdly and finally, my corporate partner at Brodie's, Will McIntosh. Will specialises in domestic and cross-border M&A and private equity transactions. He has over 25 years experience practicing in the UK and France and is co-chair of the International Private Equity Committee of the American Bar Association. He has particular sectoral expertise in tech and life sciences with a previous career in intellectual property, now heavily focused on tech M&A private equity deals. He advises a number of US and European private equity and VC funds, as well as high growth companies and multinationals. His corporate clients include software unicorns and listed companies, as well as sectoral leaders in technology, biosecurity, life sciences, and energy. Now, our intention today is to have a largely conversational experience, dealing with questions towards the end, but perhaps, Will, you can kick us off?
Thanks, Eric. Yeah, so I thought I would just set the scene. And now basically the presentation is going to be largely around exits and driving businesses towards exits. So I thought I would set the scene in terms of the macro picture, because timing is everything when it comes to M&A. It's a bit like location, location, location. When it comes to M&A transactions, it's largely about timing, positioning, and sector. So I thought I'd just briefly introduce the sort of macro overview and what's been going on in the M&A market. There's been a lot of deal flow in the last few years, but it's actually reached fever pitch activity at the moment. And actually, what I'll do is I'll quickly share a graphic to just illustrate the point, because the markets have been incredibly buoyant in the last few years. Here you'll see deal activity and deal value. The blue charts are values and the gray at the top is activity. It's a number of deals, and you'll see that from 2014 to 2021, it's gone up and up and up. But what you'll also see is quite a marked downturn. If you look at the deal values and volumes, back in Q1 and Q2 of effectively during the pandemic, you'll see that there was a massive drop in deal activity. Now that's obviously easily explained, but what that meant was the lowest point in 25 years for M&A. That's how profound the pandemic was, and actually led to quite a few structural changes in the M&A market. But remarkably, it only lasted, and we sort of saw this firsthand. We saw basically only effectively 90 days worth of disruptions, just a couple of months worth of disruption in real terms, in that deals slammed on the brakes and then picked up very quickly once people settled down and the markets came back. So it really only took till June before the deal activity picked up, and picked up dramatically, as you can see from the significant uptick. And if one looks at the sort of month by month figures for the US activity, you'll see again that period back in April, May, June, when volumes and values were right down, and then it picks up significantly. And once again, the surprising thing was that throughout this period, with the sort of cross-border activity going on, values, and this is the sort of valuations actually held up throughout that period, which is quite remarkable that during a pandemic, valuations should have held up so high. So I'll just stop sharing just now, but one of the reasons for that is that there's a huge amount of what's known as dry powder. So that's basically private equity money that's been raised, ready to be deployed. And these private equity funds have got bigger and bigger and bigger. We're at record levels ever. We've raised sort of twice the amount of PE funding compared to the last few years. And that dry powder is looking for a home. So you had a period when the brakes slammed on. And one of the reasons the brakes slammed on was that the debt markets went away. So whilst private equity was keen, debt funders took fright at the pandemic and basically pulled a lot of their funding. And private equity heavily relies on leveraging their sort of funding package. So basically paying part of the purchase price with debt. And those brakes were slammed on. So that we saw that firsthand in our own deal flow. We had quite a few deals where private equity backed, where the debt package just vanished overnight. What that effectively meant was sort of a complete restructuring of deals, and we'll come on to that in a second. But the other global trend has been the sectors in which deal activity has been really active. So if you think about it, during the pandemic, the sectors that did the best tended to be healthcare, tended to be the disruptive technologies, so software in particular. And when you look at cross-border M&A activity, software, well, sort of tech and software now represent a third of all cross-border M&A activity, and in particular, a third of the cross-border activity coming from the US. And it represents about 30% of the inbound US, in other words, European companies or Asian companies buying US software companies. So again, that's been a huge driver, and that's one of the reasons why, again, valuations held up and why the volumes held up. So really, tech has been one of the great success stories, along with, to a lesser extent in Europe, infrastructure and energy, which have buoyed some of the European activities. I mean, I'm guessing, Tom, you'll have also seen quite a bit of activity which sort of reflects that.
Yeah, you're exactly right, and good afternoon, everyone. So we saw the doom and gloom of the pandemic when it first hit, and what I sort of coined the phrase of sort of COVID-safe assets continue to trade through that period. So the infra energy sectors in Europe, like as you touched on, pretty strong and continue to trade during that period. But then absolutely a significant bounce back for these tech-enabled assets that obviously people could see. And rightly so, diligence remotely is quite a key thing which we saw, and the assets that could be diligenced remotely, therefore people jumped very quickly to obviously to look to trade these assets. When you touch on pricing, I thought it was quite an interesting point that you made in relation to the multiples applied, and that the sort of the bounce back and actually the increase in the multiples. We actually thought it might be a bit of a leveler in relation to the multiples of the pandemic, because obviously everyone was talking about the dramatic increase in the multiples being applied on these assets. We thought it would be a leveler. Actually, it's gone the opposite way. For these good assets, they've actually become even more competitive, and the process has become even more competitive, and actually the multiples have increased. And to that extent, if you look at it from an insurance angle, the underwriters are actually now taking a keen view, looking to look at the modelling and actually what multiples being applied even before underwriting, which, if you talk about it pre-pandemic, that was never discussed, and it was not actually a consideration as part of the insurance side and the W&I side. So it is an interesting development in relation to the new multiples being applied to these, I'll use my phrase again, COVID safe and these tech-enabled assets.
Because that certainly is our experience. I mean, one of the interesting things about valuations is actually if you drill down into the valuations, although the headline valuations have stayed high, what happened, particularly during the pandemic period, was there was a greater return of things like earnouts. So earnouts suddenly came back into it. Effectively, that's a way of sort of bridging the gap between the seller expectation and the buyer expectation. And the other thing that was interesting in terms of the earnouts is that whereas historically you probably would have seen earnouts based on things like EBITDA, because of the fluctuations during the pandemic, cost bases were all over the place, revenues potentially all over the place. In certain industries, for instance, outdoors suddenly exploded and everyone was wanting to buy their jacket to go outdoors, and was that a blip? And so people were coming up with different, rather alternative metrics when it came to the earnouts. So, for instance, annual recurring revenue became a theme, or gross margin, but very little based purely on EBITDA because of the uncertainty as to what you would actually be, where that would land you because of the cost basis being all over the place. So, and the other element was, although again, headline prices looked normal, what we ended up doing in a number of deals was totally restructuring the package, where sellers were expected to basically stump up some of their own purchase price. And the way that happened was largely through things like loan notes, so basically vendor loan notes, where you effectively gave the vendor an IOU saying, we will pay you, but we will pay you in 12 months time or even 24 months time. At the beginning of the pandemic, when we were even suggesting 24 months for a third of the price, and the guys were going, yep, fine, we'll take it. Just give us a bit of an interest rate and we'll take it. So you're effectively getting sellers plugging the gap where the debt providers fell away. And so we had that in a number of corporate deals and PE deals. So there was a lot of restructuring of price going on. But then it's really been a tale of two halves in that the first half of last year, you sort of had the pandemic effect. But equally, whilst the price was being reduced and whilst the sort of money left on the table on day one for sellers was being reduced, the sellers were also saying, well, okay, but you can't hit us twice. So we'll accept a reduced price, but don't come after us for high levels of warranty. You're already holding some money back from us effectively through earnouts, through deferred consideration. So we're going to want low caps on liability. And so that was another trend we saw coming through. Now, that was the beginning of the year. All of that swung around because the power went back to the buyers in the second half of the year. A lot of new companies came on in the sort of beginning of this year. A lot of new companies, processes have come on, seeing the feverish activity amongst the private equity to buy up prize assets. So a lot of new targets on the market, which actually, funny enough, has meant that buyers have been able to be much more selective. So flood of sellers suddenly because of the high valuations, and very selective buyers. So buyers are basically turning propositions away quite regularly now and being much more selective. So it's back to the buyer power again.
Well, can I come in here and ask Tom a question? Tom, you referenced in the context of the pandemic, remote diligence. I know that's been a bit of a hot topic. What's been your experience in terms of buyers or insurers doing the sort of diligence they would truly wish to do?
Yeah, it's an interesting one. So obviously the old adage of people wanting to see the whites of the eyes of management and in relation to a diligence exercise. And I think initially that was sort of across the board pretty much what the market was. But then there was obviously the one or two that went out and actually say, we don't want to be the last to deploy. So what can we do in relation to actually remote diligencing? Insurance, we're quite keen from the broking side, is that the insurance is not the cart leading the horse. So we've sort of pushed insurers to effectively say it's accepted, and I think widely across the board now that point is accepted, providing the diligence in areas that have been warranted and looking at things like the impacts of the pandemic, the impacts of COVID-19 on the asset and the warranties thereafter. Providing that's been undertaken, most insurers are now pretty accepted, and it is the case that remote diligence is fine. There are some outliers in relation to some real estate assets and actual physical inspections, etc. So when in like significant environmental risks, but generally across the board, that's mostly accepted now.
It'll be interesting going forward to see to what extent that just normalizes. Will, back to you.
I think it's probably here to stay, to be honest. I mean, we're now finding that even management teams are doing much more remote interviewing of, well, sort of their counterparts in terms of the buy side and sell side discussions. There's a lot less travel, and ditto for the diligence. I mean, in terms of other trends, I think the other trends are, given how international deal flow is nowadays, we have seen a huge influx of US deal norms as opposed to UK deal norms. So that's been the other sort of big game changer. I mean, our own deal flow, we'll probably have over 50% of it will be international, and certainly 90% by value will be international. And if you take the sort of 32 deals I did in the last 12 months, of that, over 50% were US buyers, about 20% French, a bit of German and others. So the purely domestic deals are very much a thing of the past for certainly mid-cap deals. And what that's meant is greater fluidity when it comes to deal norms. The UK has always slightly stood at one end of deal norms. We've always been a bit of an island when it comes to that. When I used to work in France, we followed more the US deal norms. So I think the rest of Europe probably aligns much more closely with US deal norms. And I'll come on in sort of second part of the talk as to what that means in granular terms. But that's certainly been one of the themes. The other big theme has been the rise of protectionism, and that's been a bit of a barrier to deal execution. So whereas pre-pandemic and a few years ago, people were doing deals quite liberally, you just had to satisfy merger control considerations. Now you've got a great deal more protectionism, both from the point of view of supply chain security. So for instance, pandemic, we saw people getting really worried about supply chain security when it came to medical, masks, you name it, breathing apparatus, etc. But also at a geopolitical level, where a lot of it is being driven by this, well, effectively the paranoia about some of the, for some of the Far Eastern countries, without naming them. There's very much, particularly the US has driven the agenda when it comes to making sure that key assets, key infrastructure, anything to do with anything that might impact, well, I mean, initially it was under the banner of security, but that's cast very widely to include enabling tech fundamentally, because they don't really want other people getting a jump on tech when it comes to outdoing the US economy. And that has been imposed. I say imposed, it literally has actually, because we've been encouraged to adopt similar regimes across Europe, with some potential sanctions if we didn't. So net result is you've ended up with these tools being put in place, but these tools are now being actively used by government. So whereas before it was probably we were being asked by the US, please put this in place because we want to be able to review Chinese deals. Now actually governments are using them for their own purposes and saying, well, actually this is quite a good idea. We need to be a bit more protectionist. So we're finding deals now being, having to deal with that additional overlay. But I think the final theme that I was just going to touch on is really just the prevalence of warranty indemnity insurance, which feeds into Tom's area, because any well-run process nowadays on the sell side will automatically be thinking about warranty indemnity insurance. And that's really had quite a profound effect on the way deals are structured, the risk profile. And I will pass over to Tom on that front.
Thank you. So it would be good to start and just give an overview of the history of warranty indemnity insurance, a starting point for those who are not too au fait with it, and then moving forward to implementation of it, the process, the trends, and rightly looking at the costs of it. So we're quite keen as a warranty indemnity insurance transactional risk broker. So we broke the transaction in relation to that. Quite keen to say that it's not a utopia in relation to a transaction. You can't effectively just assume that you buy a policy like you buy a holiday insurance, etc., and it's just there. We don't need to do anything. We pay the premium and it's there, and it just covers the warranties in relation to that. We're quite keen to say that it's not that. It is a work stream in itself, and it is a work stream that you will need engagement from advisors, both financial, legal, technical experts, and then your brokers as well, in relation to implementing that. So it is a work stream that should be considered and will take up time as part of the transaction. But to give you some history about it, so the idea of the warranty indemnity insurance came more prominent out of the last financial crisis, to say last financial crisis, but it came out of the back of it in relation to looking at what could be done with insurance to look at a full stop position as a creditable recourse in relation to a transaction. And it was mainly utilised on real estate, so high value real estate, looking at what can we do with insurance to be the full stop, i.e. can we look at bringing a claim ultimately against an insurer to play a claim once a warranty claim or indemnity claim has transpired as part of the transaction. And traditionally it was taken out in the sell side. So most insurances, when it was in its infancy, were taken out by the seller. So buyers would bring the claim against the sellers would then introduce the insurers as third party to those claims to effectively pick up the capital L loss. There has been developments and dramatic developments in relation to warranty indemnity insurance since that time to bring it more in line with what I would say is a traditional M&A deal. Insurance at its core can be seen to be slow, a little bit archaic in relation to how it implements the policies, where actually the M&A community and the deal community, it needed to be a bit faster paced. It needed to be more aligned with actually a transaction. So that means a dramatic flip is what we now call the buy side policy. So it's an insurance policy mainly now, there are sell side policies still available, but mainly taken out by a buyer in its own name, and it is almost a first recourse in relation to a claim under the transaction documents. What that means is the sellers do not need to be engaged whatsoever in a potential claim. So the buyers don't need to introduce sell side. They will go direct against the insurer to bring a claim under the transaction. So that's been a dramatic shift in relation to how that's implemented. What does that mean for a transaction in that case? And when Will touched on a well-run process, it's quite nice to hear that in relation to how you obviously consider the warranty indemnity insurance, and we're very good at propaganda in that well-run process should be considered in relation to warranty indemnity insurance. But well-run process means, so we often get our grubby little hands all over the SPA when it's an auction draft SPA, and we will work with legal advisors to frame the transaction documents in such a way that they are insurable. And then we will obviously, what we'll do is we'll go to market to get some indication on terms. So we will approach a number of insurers to look at who's the best place to insure this transaction, who is willing to cover those warranties and indemnities to the extent, obviously, there's potential loss. And actually, we will present that as part of the auction process. So we work with corporate finance, we work with the legal teams, we work with some type of vendor advisors to actually frame that. And what we then do is we present that up to bidders to say, we've effectively done this process for you. We've done the legwork in the first instance, and we will give you access to Lockton to implement that, should it be on a contract race basis where we can run multiple trees, whether it's an exclusive buyer and they're going through their own diligence process. And that's what we say in relation to a well-run process. The reason for that is the number of insurers has dramatically increased, yes. So we're probably at close to 30 insurers now who look at warranty indemnity insurance on a, let's call it, a European transactions. But of that, they can be closed off. So if you on the sell side were running a process and allowed buyers to go away and run the warranty indemnity insurance individually, you could effectively block out the market. You could effectively block out the best insurance terms for other potential bidders, which then impacts in relation to the negotiation and the bid process. Because one bidder may well have a preferred insurer who has the best terms, but that insurer is then blocked out because they've provided terms to that person. So that's why we talk about AI being a well-run process, is i.e. we do that on the sell side, we get the best terms and we present that forward to potential bidders. And let's touch at cost. So if we talk about it pre-pandemic and post-pandemic, that's quite an interesting way to look at it. And I think in its macro sense, it's quite interesting to look at insurance more globally in relation to how they impact on pricing. So pre-pandemic, what we go through, and forgive me, we call it a soft market in relation to warranty and indemnity insurance. The reason for that is there was a dramatic increase in number of insurers. So that allowed us as brokers to run pretty competitive processes to bring premiums down to increase coverage as well. So pre-pandemic, I would say it was at its lowest it's probably going to be for a long time in relation to the premiums and the costing of insurance. The pandemic allowed for a sort of leveling off. Generally, in relation to global insurances, it went through a hard market. When we say hard market, premiums went up because claims went up. Therefore, effectively, the implementation of insurance was a lot harder. We sit in our own little world in warranty and indemnity insurance. We are affected by global trends, but more so because of M&A trends and M&A claims in relation to the transactions. So on the back of it, our actual premiums stayed pretty level. We played pretty level in relation to the pandemic. There wasn't much fluctuation. We're going through a quasi-hard market. The reason for that is what Will touched on earlier, is just the sheer volume of transactions. That's allowed capacity constraints, if I'm honest, capacity constraints in relation to the insurers basically saying, we've got other deals on our desk. We can price it at a little bit higher. So we are seeing a slight increase in premiums. So pre-pandemic, for operational deals, as a rule of thumb, we said 1% of your insured limit. That's potentially what your costings would be. So for a £10 million enterprise value, say you took the full limit in relation to that, you'd be at about £100,000 in relation to the premium. That was a rule of thumb. You wouldn't be that far off. It will change sector to sector for operational deals, but that's generally where we thought where we'd be. Post-pandemic, because we're going through this capacity constraints in relation to each of the markets, we're probably at 1.3, 1.4 at the minute. So your £100,000 premium is now £130,000, £140,000. So there is been a slight shift. The reason for that is not because of too many claims, and we can touch on claims in a moment, but it's more so just purely capacity, i.e. the volume of transactions, and that's allowed for it, for that change. If we look at it from a claims perspective, so I always look at warranty and indemnity insurance in two mindsets: the implementation of it, the actual looking at the transaction side, but actually why it's there. You look at it in the post, actually the claims data. The reason why you buy and pay the premium for it is actually, will it deliver on what it promises to do, and i.e. bring the protections for those buyers. And generally, the sentiment we have is that it is responding. The reason for that is the insurers need this policy, this product to work, because they need good PR in relation to that. So they are coming out in relation to and paying those claims. We are seeing an upward trend in relation to notifications on those claims, but I think that coincides with the number of policies being placed as well. So obviously, if you look at the graph, the number of policies dramatically increasing in relation to the number of deals out there. And I say from year on year, we're almost, from our perspective, from the locked-in perspective, we've done more policies this year, i.e. calendar year, than we did in the whole of the year before and the year before that already. So there is a genuinely upward trend in the utilisation of it. So therefore, on the back of that, claims notifications will likely increase as well. And just one quick point in relation to claims as well. I think people are seeing it and becoming a bit more au fait with the product. So actually saying, we paid an additional premium, we paid the premium for it, sorry. It's a non-renewable insurance. So why can't we potentially look to recourse in relation to that as well? So that's generally something we're seeing as people, what we call try-ons, which is fine, which we understand, and we will work with the insured to make that try-on. And there's also, and Will and his teams like that will have some lovely warranties that we can try and shoehorn some claims into. But that's what we're seeing in relation to the number, like the upward trending claims. But yeah, so generally the utilisation of it is dramatically increasing over the last couple of years.
Tom, thanks. We are going to come back to the claims record. Ian, I'm going to ask you to speak now about the management viewpoint on running a successful exit, perhaps in doing so because your CV does reflect considerable global experience, perhaps reflecting some of the comments that Will was making about the trends that we're seeing internationally.
Yeah, well, it's interesting listening to the guys talking, because I come at it from a point of view of running a business. And when you start running a business, you don't think too much about W&I insurance and what advisors you might need. And I've been involved in 5 exits to a greater or lesser extent over the last 20 odd years. And it's the old story. I wish I knew then what I know now, you know. The first deal we got involved in, we did Scotland's biggest management buyout in 1998, which was about 65 million. We raised money from 3i and RBDC at the time. And they were very different kind of investors, I think, than you've got now. Frankly, they brought money and not much else. And as a management team, it was very difficult, because we were running a software business. We've been profitable and successful for 20 years. And then you've got all these guys coming in, giving you advice as they see it. So it changes the dynamic dramatically in a business. And you might ask, well, why are you doing that in the first place? So I think that if you're growing a business, you've got to say, what am I trying to do here? You know, am I trying to get seed funding? Am I trying to get significant funding to grow the business? And you've got to think very carefully about that, who you want to bring on board. Because if you get on, you know, friends and family, or you get on an early stage VC, they're very different beasts and they want very different things. So you've got to think long and hard about who you want to bring on and then what you want to do. And if you get to the stage where you want to do an exit, why do you want to do that exit? Is everybody aligned? Of course, if you've got one main investor, it's easier to align with your management team with them. If you've got 10 investors, it gets more difficult. So how you structure the business at the beginning, who you bring on and how many shareholders you have, and what you want to do, what you want to achieve is really, really important. And I think I've seen companies sort of fall into things and get involved in processes with no clear thought up front about what they're really trying to achieve. And even within the management team, you'll get different views. And this gets very difficult. The key thing I would say is everyone's got to be aligned. And if you're not aligned, it can go horribly wrong. So then you're saying, are we going to do a trade sale? Are we going to sell to somebody in the business? Or are we going to do an IPO? Or what kind of exit we're going to have? And that's got a whole lot of other decisions that you have to make along the way. And of course, you've got to do all of this at the same time as you're running your business. So you've not got to make sure you're not dropping the ball. And therefore, how do you divide the task between the management team? And I would say you try and keep that to a very small part of the management team, the chief executive, and maybe your finance director, to vet people and see what you really want to be doing. And I guess, we had a sort of 3 golden rules. We sort of said, it's better to be bought than sold. Sounds obvious, but what a difference that makes. Talk's cheap, because people are at you all the time. Every second day, you've got some great VC from around the world telling you what a great job they can do for you. And it's never over till the money's in the bank. These processes go up and down. One day you think they're on, the next day you think they're off. And again, that's very difficult for a first-time management team, I think. I find it very difficult. Is it going to happen? Is it not going to happen? Your emotions are all over the place. It gets a bit easier as you're down your second and third and fourth deal, just because you're used to these processes. But, guys like Tom and Will do it every day. Management teams don't. You might do it once in your lifetime. You might do it twice, but, once could be your big exit, and that could be, setting yourself up for life. So there's loads of issues, and first time round, it's just very difficult. You need some advice. I think you need to speak to somebody that's done it before, preferably a number of times, has got experience in the sectors you're talking to. Geographies are very different, as Will mentioned as well, what the expectations are. My first deal was, we did a management buyout and then we sold to a German quoted company, and that was in 2000. So that was the beginning of the dot-com kind of nonsense. And they were very different. They'd raised a lot of money. They weren't a real business. We were a very well-established business. We'd grown from 50 people to 1,000 people in 4 years organically. I think we knew what we were doing, and then came this crowd that perhaps didn't really have the experience that we had. And that changes the dynamic. And what they wanted us to do was roll over some of our equity as well. So it wasn't a clean exit. And that raises a whole other number of problems. So just loads of issues. The last exit I did was just before the pandemic, actually. We sold to Zebra Technologies, which you mentioned, Eric. They're a $6 billion turnover American business that works with all the retailers in the world, 10,000 staff, very experienced team that came in to do the process. So they had a specific team, they buy 10 companies a year, and it was really well run and really well managed. And that made an enormous difference. But also, you know, who you choose as advisors. So again, there's more advisors you can shake a stick at, but we chose an advisor, West Coast of America, that was absolutely in our sweet spot in terms of industry, artificial intelligence, computer vision. They knew the industry. And the other key thing about that is you often get sold by advisors, and you get sold by the really good, smooth top guy, and then you get handed some kind of more junior guy to run the process for you. Absolute disaster. You want to hold on to the guy that's really good at doing it. And the guy that we chose in America was on every single phone call, ran the process brilliantly, he knew all the pros and cons, and he makes the process just much easier for the management team and takes a lot of that pressure off you. So at every stage going into a process, why are you doing it, what advisors you want to use, is everybody aligned through to the exit process and what you're trying to achieve? Do you want to roll over? Do you want to stay in? Or do you want to completely exit? Who you want to work with? And you'll get all kinds of different offers too. You know, some offers will be higher than others, but there's pros and cons of those offers. You know, what it is. So evaluating those offers, again, a whole lot of issues. So for a management team coming into this, there's a huge number of unknowns. You know, you just don't know what you don't know yet. And getting the right kind of advice is absolutely essential. And speaking to someone that's done it before will really, really help you. So loads of issues.
I liked your 3 golden rules there, Ian, and in particular that last point about advisors that know the industry, because time and again, Will, Tom, would be interested in your experience, but time and again we find that nobody quizzes you on, do you know the law, or do you know the insurance industry? Do you know the targets industry? Understanding those sweet spots, the things that keep you awake at night, and as a warrantor, more so. And that's good advice in terms of not getting the junior guys. And it's a common experience in Scotland for clients using perhaps advisors for global transactions, and you lose the local contact with the guy that knows your business best. Actually, Will, I know you've got a lot of granular detail to get into. Shall we move on to your section next?
Sure. Actually, just one of the things that Ian was mentioning, the other aspect that's quite interesting is I think management teams are often focused on, you know, running the day-to-day business, and a bit like they always say, when it comes to working out what your product should look like, speak to the market, work backwards. With an exit, it's very similar actually. People should be thinking very early on, what does the perfect exit look like, and what do I need to do to achieve that? In other words, you know, who are the likely buyers? What's going to make the company look good to them? And, you know, how do I put the building blocks in place? I think that's a sort of very valuable thing to think about. Turning to the sort of more granular stuff, what I was going to talk about, and this is really just sort of pooling together our own data, our own experience of deals, as well as, so I'm involved in the American Bar Association and various committees, and we publish quite a few deal point studies, and they are remarkable in terms of the data they've got in them. Much easier in the US because a lot of the data is publicly available, much more difficult in Europe. But there have been studies on deal norms in the US. We've done some studies on deal norms in the EU. And then, you know, we all see what goes on in the UK. So it's really sort of pulling a few of those strands together to give you a bit of a picture as to what the lay of the land is, in particular, if you're dealing with an overseas buyer, how to react, because you can actually adapt your strategy depending on who the potential buyer is. And if you know the norms on both sides of the pond or both sides of the channel, you can actually maximize the outcomes, both in terms of price, the way they'll think about it, and the risk you take on the back end, because it's all very well being written a check, but, you know, what are you going to end up giving back, either through the price adjustment mechanism or through just warranties generally. So really pulling some of that information together. And again, I thought I'd just quickly share one visual, maybe even two visuals. This is really just to give you a bit of a flavor as to what, and this is comparing the UK and the US in terms of which jurisdictions are more seller favorable. That graph kind of gives you an indication that it's not all UK and it's not all US. There's actually a bit of a mix. And if you can mix and match in the right way and sort of have the right conversations, you can actually end up with a pretty stellar result. If you mix and match in the wrong way, you will end up with a truly atrocious result. So that's where it's really handy to know where the other side are coming from. And you often end up with completely parallel conversations going on because fundamentally people haven't understood each other's terminology, concepts, the construct of the price. And we'll come on to locked box, for instance, but in the US, locked box is basically taking a historic balance sheet and pricing the deal based on a historic balance sheet. So you're effectively moving economic risk from seller to buyer at the point of the locked box. So that might be, you know, sort of 2 months ago, you do your management accounts and you use that as the balance sheet that people price. And that effectively gives you economic risk passing 2 months ago. That concept is pretty alien to the US. They don't get locked box. And actually, even at the American Bar Association, we've run a number of seminars. We keep having to rerun them because they just don't get it. So it's a sort of novel concept that suddenly they're all excited about. So for the last 2 years, they've avidly been coming to every single seminar on locked box, but you still end up with the most bizarre conversations going on because they bring it back to a closing accounts mechanism. And what that effectively means is they're bringing it back to a mechanism where they are pricing the deal at completion. So you have a price adjustment right up to completion. And the reason, I'll just maybe stop sharing at the moment and we can come back to this, but the reason that's been particularly relevant recently is that if you take the volatility within the pandemic period, people didn't know what was going to go on in terms of trading. So if you priced a deal based on a balance sheet that was 4 months ago or 6 months ago, and you say, we'll take the business as usual trading risk after that date, as long as the seller hasn't raided the kitty and taken money out of the company, we as buyer will take that risk for the interim period. That becomes hard to swallow in a highly volatile market. And so you found that whereas before lockbox was pretty normal in the UK, suddenly people were going, well, hang on, actually, do I really want that as a buyer? I'm going to be taking economic risk over a period that I just don't know what the hell's going on. So let's make it a completion accounts mechanism where there'll be a true up of the price based on actual trading right up to completion. So we've, in the UK, we sort of swung back towards a bit more of a completion accounts mechanism. But certainly if you're dealing with a US buyer, it doesn't matter how many times you tell them lockbox, they will just end up trying to reapply a completion accounts mechanism unless it's an auction process and one of their advisors makes them fully understand the consequences. So that's an interesting comparator between the UK and the US, but it's not all so it's not all linear. And over time, what we found is that, for instance, the one thing that people care about when it comes to being on the sell side is you end up very concerned about your potential liability downstream under the warranties and indemnities. And yes, we do see quite a number of claims. I mean, in the larger scheme of things, in 600 deals, I don't know how many warranty claims we've had, not that many in larger scheme of things. So it's probably an overblown concern. There will absolutely be a price adjustment under a price adjustment mechanism, but warranties less so. But what I think an important thing for sellers has always been caps on liability. And that's where, if you take the UK compared to the EU compared to the US, very different positions. The UK has always historically been capped at the purchase price, and then progressively the caps have come down over time. but we're nowhere near the US levels or indeed the European levels when it comes to the sort of how low the caps go. So for instance, in the case of the UK, actually the average, the sort of blended average is somewhere in the 40%, sort of high 40s when it comes to caps on liability. And I'm not talking about in the case of warranty and indemnity insurance. This is just in a sort of classic deal. The EU, the mean is about 33%, the median is about 15%. Whereas US deals, you're right down into the sort of the low, basically sort of 10%, 11% type region, and even sometimes below. So you can end up with very low caps on liability under a US style deal. Now they do their warranties on an indemnity basis, but actually when you work through the limitations on liability, you fundamentally end up in the same sort of place as the UK anyway. So it's not something to be overly concerned about. But with the US, there are always exceptions to the caps. So the things that blow the caps off will be things like ownership of shares, what they call fundamental warranties. Now, the category of fundamental warranties can actually start becoming quite wide. Tax tends to be in there, but if you're dealing with any Silicon Valley companies or advisors, it's pretty much the norm that IP will be a fundamental warranty, because they're saying, well, what are we buying? We're not buying shares, we're buying your IP. You can't tell me that you're not guaranteeing your IP. And so that tends to be a sort of hot discussion, whereas that wouldn't compute in the UK. I mean, we would say, what? Capped at the purchase price for IP? Why are you carving that out? So that's an interesting trend from the US, as well as they've just cottoned on to data protection. So whereas 2 years ago, compliance with data protection, cybersecurity wouldn't have been a fundamental warranty, you're now seeing it creep into Silicon Valley deals in a big way, because they've realized it's a big problem. And California's also now got some data protection laws. So they've become a bit more aware of it. But fundamentally, they all kind of know the EU data protection rules. So that's been the other interesting trend.
Will, can I just come in here?
Sure.
Ian, you were nodding vigorously when Will said that. What's been your experience?
Yeah, so GDPR in my last deal with Cortexica, again, American buyer coming in, and they came out with GDPR, and I said, what do you mean? And they didn't know what they meant. It was one of these, oh, it's a big thing. I said, it's not a big thing, not for us. We're not holding data. We're not, and they just didn't know what it was, but they thought it was a big deal, and they carved it out. They eventually caved in and ignored it. But yeah, it was a huge issue, but in real terms, it wasn't a big issue at all. So I think they pick on things like that. And IP, of course, is another big one. And when you actually drill down to what do you actually mean by that? What is your concern? What do you think we hold? It can evaporate. But that was it. It's interesting. That was one of the ones I had in my last deal.
Interesting. And Tom, I presume you also, you'll be seeing these debates secondhand.
Yeah, you're exactly right. It's very interesting to see the trends, the shifts, and the dynamic of things, and how actually the more requests we were seeing. So you're looking at a traditional W&I European policy, where you're looking at actually people wanting now to look at sort of the US style, what we call enhancements to it. So you're looking at sort of the general, like, full suite. I think one thing we're keen to say is it's tomatoes, it's reps and warranties over there, it's warranty indemnity insurance over here, and we say it's the NFL of litigation in the US. So, but you pay for it. So the policy itself is different fundamentally, but you pay a dramatic increase. So over here, we were looking at operational deals at 1.3, 1.4, you're at your insured limit, you're at 3% for US style transactions. There is a creep in relation to the enhancements and pricing a little bit cheaper over here in relation to that, but it is an interesting one. And then you're exactly right in looking at to widening the scope of fundamental warranties. So we're actually getting those requests for in a warranty indemnity insurance where fundamentals are traditionally your title, capacity and insolvency. Actually, can we include the IP? Can we include the data protection to covering it at higher levels? That's right, and at longer periods as well. So instead of the traditional 2 years for general warranty coverage and warranty indemnity insurance, we're looking at full seven-year coverage to match it to like fundamentals, which is definitely a trend that we're definitely seeing an increase in relation to it. And just finally on the I think GDPR is a really interesting one that Ian said, and people say cyber as well. Well, cyber. Well, what does cyber mean? Is that cyber breaches? Is that your IP behind the cyber? Is that your source coding, etc., etc.? I don't think sometimes people understand the definitions that they throw around there. Once you drill down to it, GDPR is a prime example. It doesn't really matter if an asset doesn't hold any data, doesn't have any potential issues in relation to GDPR. And that's how it flows through to underwriting from my perspective as well, is, okay, is this intrinsic? Does this mean anything for the asset itself? Yes, there'll be warranties to that, but actually this is not a high risk asset. Okay, the underwriters, and we're keen to push them to say, actually, okay, fine, this is a little bit more, it's not an impact, there's no value in relation to that, so they can be a bit more relaxed around the extent of the diligence that's been undertaken, and then therefore the coverage in relation to that. So it is an interesting development, and the sort of the US influence on European deals.
I mean, the other element that sort of feeds into that, if it's not an insured deal, there's always the question of how does a buyer get comfortable that they've got adequate recourse, and there's always the sort of question of holdback or escrow. And that's another area where there are marked differences between the US, the UK, Europe generally, where the US tend to be pretty low when it comes to the amount of holdback that they would require. I mean, it sort of tends to be around, around the 5% if you took the mean. Whereas in Europe, it tends to be more around the sort of 10% mark. But actually, with all these things, people will tell you, oh, what you're asking for is not a market. There is no such thing as market, because actually when you drill down into things, market is all about the size of the company, the size of the deal, the sector you're in, the degree of risk, how many identified issues there are, etc. And when you look at the stats and start analyzing, okay, so it's an average of 5% for a US deal, but actually for a lower mid-market deal, so anything under 100 million, you're talking about 10%. So the bigger the deal, the smaller the holdback. So in these mega deals, you're right down into the sort of 1%, 2%, and that's what skews the figures. So I think if people just purely rely on the published stats and don't actually drill into it, they'll sort of get a wrong idea of market. And that's where basically you kind of need to know the pressure points, the particular buyer, and where you fit into the deal market. But I'm conscious that we've only got 5 minutes left, so we were hoping to leave some time for questions.
We do have some questions, and if I can just remind folks who are listening in, this is your opportunity to send some more questions for the panel. Will, I would just add to what you were saying there. There's an interesting dynamic with the advisors looking at the US perspective, because the US lawyers, who tend to like to take a lead on the buy side, then have some arm wrestling with their UK advisors for the same client. And I've got one just now, in fact, where what they're literally negotiating with themselves, as the UK advisors are trying to bring the US advisors round to what is perceived to be market standard. But you're right, there is no golden standard that defines market. Can I come back to Tom? There was one question on policies and claims. You said previously claims have gone up, but then not too many. And I think rationalized it on the basis of it's just statistics because there are more policies. So it follows that there will be more claims. Can we just be absolutely clear whether there's a greater dependency or reliance on policies now? That's the sense I have.
Yeah, I think there is, and we're good at propaganda. So we're effectively good at working with corporate finance to effectively sell this magical £1 cap for sellers, to say, actually, don't worry about it. You go away and get the insurance, and that the insurance is therefore as your recourse. Where traditionally you potentially look at escrow, you'd look at holdback, you'd look at a mitigation via the deferred consideration. Where actually now, with us being good at propaganda with corporate finance, advising the corporate finance advisors when pitching to management, traditionally part of the institutional exits, but with management, I should say, we can look at the warranty indemnity insurance as the first and only recourse in relation to a transaction. So I think PE has generally come on board and start to understand this when it is a seller's market, that okay, even with a management exit, and it's not an institutional exit, that warranty and indemnity insurance is what's on the table, and that's how the process is going to be run. Yes, there are conversations when there are known issues, things are flagged as DD. There will be conversations further down the line, but actually being seen as the only and first recourse has definitely mean there's been an uptake generally as well in relation to claims. Yes.
That's interesting. That I think that's the US market tends to be much more aggressive on that approach, and I think. I know the stat for this actually. I think it's only 14% of deals in the US will have warranty indemnity insurance as a sole recourse. So it's actually pretty low. So in other words, it's maybe primary recourse, but it's not the sole recourse. So I think that's where it's much more favourable in sort of UK auction processes than abroad.
Yeah, we've been good at propaganda, haven't we? So that's
yeah. Ian, what's been your experience of W&I?
Yeah, well, actually, my first deal back in 2000, we had insurance for that deal. And I think it was fairly new then, obviously, and it came down to the confidence you had in the people that were acquiring you as well, whether you thought that they might be likely to make some kind of claim. And we were persuaded at that time that it was a good idea. As it turned out, there was no claim, but it's, you felt a bit uneasy at the fact that, you've put some money in the bank, but someone could come along and take it away from you again. So we did it at that time. We had it in one other deal as well. I think it was, again, it's, as we said earlier, part of a good process. You'll consider it. You don't always have to have it, but it certainly should be considered. And it probably depends on the geography as well, who you're talking to. But yes, it's always talked about now, whereas 20 years ago, I think it was pretty unusual.
I think you're right, Ian, that we've looked as a broker, have invested in corporate lawyers like myself. Underwriters have invested in corporate lawyers to make this process easier. When I was in private practice, when I had less grey hair, it was a lot clunkier. The premiums were a bit more aggressive, and the process wasn't akin to an M&A transaction where actually we've had to bring it on board. They've invested in people who understand the transaction to make it easier and to make coverage better and premiums more palatable.
Yeah, and it's understanding the risk as well, isn't it? What kind of business you're selling and how clean that business is. Some businesses, every time you lift a stone, something scurries out, and therefore maybe you want some more insurance. But yeah, it's a risk thing.
Yeah. Ian, on a slightly frivolous note, you've had 5 exits. What's been your impression dealing with different nationalities in terms of those whom are easier to deal with than others?
I think my last exit was probably the best in terms of organization, and that was the American companies, Ever Technologies. And I think just because they did lots of acquisitions. The first one I did, it was a German company, .com. They'd never done an acquisition and they were all over the place. So it's if you bring in a team that does it for a living, then you've got a good chance of having a good process. And part of evaluating deals, but offers, by the way, is how's that going to go, and therefore how are they going to react to you afterwards? What's the cultural fit going to be like? How are they going to treat their employees? All those kinds of things come into it as well. But yes, the Germans were very different. Americans are different. Far East again, very different. So yeah, you got to understand who's buying you and what their culture is and what are norms for them as well.
It's interesting. So in other words, you were profiling the ideal advisor, but it's equally true of the buyer.
It is, especially if you're staying in, if you're rolling over at all. If you're just getting out and you're taking your money and running, well, that's a different thing altogether. But if you really want, if you're still growing the business, then you've got a whole lot of new people to get to know.
Okay, I'm conscious of time, and we have no further questions from participants. So I think this is the appropriate point to wrap things up and to thank you, our panel, and indeed our participants for taking part in this. It's been very helpful. I found it helpful, and I'm supposed to know my onions, so hopefully the participants in this, and Will, your US deal data was particularly helpful, so many thanks to all involved. Thank you, and enjoy the rest of your day.
Thanks very much.
Thanks.
Cheers.
Cheers.